Hey guys, welcome to this week's Money and Investing Show. This week we are looking at ESG, environmental, social, governance. It's a very popular lens for investors to look through right now when they make their investment decisions. But is it as it seems? Plenty of great quality information to take out of the show this week. Make sure you take plenty of notes, but as always, make sure you take plenty of action. Hey guys, welcome to this week's Money and Investing Show with me, your host, Andrew Baxter, and as always, my offsider and co-host, Mitch Olarenshaw.
Good to be here, Mr. B. Thank you very much for having me. And I'm really interested to hear your thoughts on this topic because I know it's a controversial one at that. I know it's one of your favorites. We're going to be talking about ESG and its impact on financial performance for investors. Big topic.
Certainly is, and I'd say it's probably one that's going to have some level of controversy that surrounds it. ESG, of course, is one of the current themes that are widely touted in the media and in the investment universe. And for those not familiar with it, ESG is environmental or social or governance filters that companies use in order to conduct their affairs. The idea being that companies need to be more aware of the environment, which I think everyone on the planet would agree with, conduct themselves in a way which is better for the greater good of mankind from a social perspective. And I guess governance in the way that the company's decision-making occurs includes things like a more diverse or inclusive workforce, for example, or a more sympathetic way on dealing with minorities and so on. So it's a far-reaching spectrum. You know, companies through their government's policy doing the right thing.
It kind of sounds quite wide, but when you look at ESG companies, they're actually rated on a scale, and that's by sector and also as a global rating. The challenge is that the ratings agency that gives out these scores is not even regulated.
Yeah. Look, ESG on the surface sounds great, and I think most things on the surface sound like a great idea, and if there, as we'll discuss in this, if there's substance behind it, that's a good thing. And if there are deficiencies behind it, then maybe that sort of title of being a more ESG compliant type business, I suppose let's use the term, could be construed as being a little bit misleading.
If we look at an example of that, just to look at the ratings on some of these. So oil companies can actually rank higher than electric vehicle companies in the example of Shell and Tesla.
That's right. I mean, if you think about, Tesla and its mission, which I think, according to one of the statements I read, 8.1 billion tons of carbon emission avoided through electric vehicles and their use, one would assume on the basis of no petrol or diesel being used to fuel them. Whether that takes into account the manufacturing process, of course, for lithium and the extruded aluminium that's used in manufacture is another matter, but we'll park that to the side for a minute. And you've got, Shell, Royal Dutch Shell, to give it its formal name, one of the world's largest oil companies, actually carries a higher ESG score than Tesla. And
Tesla's ranked medium, so it's not high or low, it's about middle of the road. And Shell ranks higher than that. That doesn't make any sense.
It really doesn't, does it? And I think, it comes down to the perception. So, for example, in my neck of the woods down at Byron, every second car is a Tesla, and people are making their statement that they're doing their bit for the environment by driving one of those vehicles, I suppose. And you look at the reality of how those scores are concerned. You've just got a pure, simple oil company outrating it, which is extraordinary. And then I guess really provides a questionable sort of overhang as to, okay, well, from a logical point of view, it just seems to make no sense. So how valid is an ESG rating when you're using it as one of the lenses perhaps that you use as an investor, which is, a very, very popular way of approaching markets right now.
So if you're an investor, AB, and let's assume that your goal is to make money, as any investor would argue. If we look at study from Harvard Business Review, so a very reputable source, on average, ESG funds charge about 40% more for their investors.
They certainly do, yeah.
And have shown no proof that they actually provide any beneficial outperformance to a normal investment.
Yeah, both of those things are true. And I think to step back for a moment, our goal and our objective, and I guess, our compliance statement as an organisation in financial services and under the Corporations Act in Australia is to always act in our clients' best interest from a fiduciary point of view, from a money perspective. And in doing so, we provide a range of recommendations and we teach our clients a broad-based approach to look at their world of investing. So we don't, I've had this asked a lot, do you use an ESG screen? And no, we don't. We'll put opportunities your way. And then it comes down to your own personal perspective of the world as to whether you would take an investment in, so, if you take something like Monsanto, it doesn't exist anymore, but, Roundup manufacturer, is that something that ticks a box from an ESG perspective? Probably not. James Hardie with the asbestosis claims, probably not. And so you could sift those out based on your own personal values, I suppose. But our job is to put those trades in front of our clients so that they can then make their own decisions. So yeah, you're right. Turning to the Harvard study that was in the Harvard Business Review, and again, we quote the source because you'd argue that being a Harvard Business Review, it's a pretty reasonably robust source of information. Their research does exactly show that 40% more in fees for investors in an ESG fund. So you can understand from a commercial perspective, talking about business philosophy, fiduciary duty. If you've got a product that you can charge 40% more for, you're probably going to push it pretty hard, which is exactly the message that we see in the investment industry. Look, these are ESG compliant funds. It's a buzzword. People are excited. It's current, and by the way, we get to charge you on average about 40% more for doing that. Quite a nice, neat model for business, and you could justify those fees, I suppose, if there was a study or supported information that showed, not maybe sometime down the track, but actually now, or even over the last 5 years or 10 years, because ESG is certainly far from new. During the start of my investing career, the first big firm I worked for, we ran, it's called Evergreen, and it was an ESG portfolio way back in the early 90s.
That long ago?
Yeah, so this isn't something that's brand new. It's something that's been around for a while, yet there isn't a formal study that shows an outperformance of ESG style investing. And so you might be buying now for the promise of what could be coming over the hill, maybe sometime down the line, but it's not stacked up from an investment perspective. It's certainly at least not now. And that's, I think, something that's really important when people are making their decisions to place their money. And as a subset of that, if you're someone that invests in an ESG fund, well, you're probably investing in companies which are already listed. You're not investing in new things to change the environment, and there's very little difference being a shareholder of a company is going to make to the running of that business. I think the latest Qantas AGM would be a very good example of that, where a large proportion of shareholders were jumping up and down about executive remuneration and the performance of the board, yet nothing's been done. So you can make a bit of noise, but it's almost a meaningless exercise. So, in that regard, if you want to have more of an impact on the environment, which all of us do in a positive way, investing maybe instead of in investment funds that are on listed securities in the market that are invested in based on an ESG rating that's by an unregulated regulator that puts an oil company above an EV manufacturer, you'd be better maybe funneling your dollars into venture capital or funding for new businesses that are developing technology, which we've actually done. We've invested quite heavily in private equity for wind and solar turbines to use on mine sites, where you can wheel out the piece of equipment and it works on solar and wind. In case you've got no sun, you've got wind. If you've got no wind, you've got solar to help power on site, which is very, very effective. But that's a private equity investment. It's not something that's listed in a major blue chip company.
So some of the risks you talk about, AB, just the trend I hear coming up is a term that we call greenwashing. So we look at hedge fund manager Sir Chris Hone made mention that greenwashing is a real risk with ESG funds. Yeah. A lot of them are talking and not a lot of them are doing. Can you explain to us what greenwashing is and what impact it has on investors? Look,
so Chris Hone is one of those people that you've got to listen to. He's embryonic in the hedge fund industry. Children's investment fund, I think, was his major fund in the UK. And the notion of greenwashing is where on the surface it looks like you're doing all the good things to tick a box in order to qualify for a better ESG rating. But really there's not much more going on beyond that. And it's, I guess, a way of attracting money in the door from an investor, which is what you want if you're able to charge 40% less. I appreciate this probably sounds quite cynical. It's the reality of the situation that's there, and the truth sets people free. We can all be of a view that, my opinion is this, but opinions don't outweigh facts, and these are facts that we're talking to. So we could look at some examples, I guess, of greenwashing, and there are quite a number of managed funds have had their ESG rating removed because they're not really investing in green businesses. To the same extent where Tesla is not part of the S&P 500's ESG compliant companies.
I think there were 1,200 funds that have recently lost their ESG tag.
Yeah,
it's a big scale.
Exactly right. It's big, but it also shows the magnitude of ESG being the logo of choice. It's like you used to have Australia made or whatever it may be, and ESG is probably the next tag to put on things from a marketing perspective, because it does draw people in, and they go, well, that's a good thing, because as human beings, we're all programmed to want to do more positive things for the environment, or the environment that we're in. So, we can look at a couple of case studies of this, and Woolworths is probably a really good one. We did a podcast last year with my really good buddy Shoes. He runs for an ESG fund for Russell, big fund, and is a great fund manager, a great personal friend, a lot of time under the bridge, both of us, and talked in that interview about Woolworths and its disposal of Endeavour. So Endeavour effectively is the alcohol and gaming business that was part of Woolworths at one point in time. And obviously, alcohol and pokies aren't particularly high up on an ESG score. They're
not at all
on the reverse of that. And so Woolworths spun it off, and the quote, and Brad Banducci's the Woolworths CEO, he's a pretty solid CEO over time, did a good job of stewarding them through COVID, that's for sure. And the time was, well, we just want to focus on our core business, and it's a good time to dispose of that asset. Okay, we'll take that on face value. But it also meant that Woolworths was scored as an ESG compliant business after it disposed of Endeavour. So you could argue that there was another side to that decision making too. So all of a sudden you've spun out the bad stuff, and now you're the clean ESG compliant company. Let's not lose sight of the fact that Woolworths also sells in excess of 2 billion cigarettes a year to Australians, and and in some way, shape or form is therefore on the hook selling a product that's responsible for the death of 1,600 people a year. And yet it can hold an ESG tick because it's got rid of grog and gambling, but it's still okay to sell tobacco. Now, to me, that doesn't really make sense. If you're going to be in the white light and a business of virtue, then that's probably also something else that you should step into and stop selling. But of course, there may be other reasons for that not being offloaded, or a more firm stance on that being taken. That's an example. And I think, companies have got to be, I guess, very, very careful in how they bleed corporate policy and corporate governance, particularly into the realm of politics. And we'll talk about that in a moment with using Woolworths as another example. On the other side of the coin, from a greenwashing perspective, if we take a business like Fortescue, which is in the iron ore, let's face it, it's in the iron ore mining space, which is not that high a scorer on many a metric. It's a very heavy user of diesel equipment. It then ships its product to China to be heated up along with coal to convert into steel. Yet Fortescue, by virtue of the vision of its chairman, Andrew Forrest, and what an incredible vision it is, have gone headlong into looking at things like green ammonia to clean power their equipment and plant and ships that they use within their business. So you've got a business there which knows it's in, let's just say, a dirty space, but is actually making very positive inroads, not just through an idea and vision, but following through with action to make it a reality, to be as low an impact business as it can be. And I think that's quite different from greenwashing, where you do a little bit on the surface and say, look, we've cleaned our act up, we're pretty good over here, come invest with us, versus actually doing stuff. Talk's cheap, money buys the whiskey. And again, if we sort of circle back to companies in their governance style, where they can bleed into politics, Woolworths is a really good example of that. More recently, if we take the Australia Day controversy, if we can call it that, where it's made the conscious decision that it's not going to stock Australia Day merchandise because as it describes, Australia Day is, it's a controversial holiday. It's a national holiday for our country. You could align that to some of the political events that we saw last year, and the referendum in particular, where 60% of voters came out in a particular way. Qantas, another example of this, where was a very active and vocal, as many companies were, supporters of the Yes campaign. That's in the rearview mirror now. We've had a referendum. Democracy has come out with its vote, and 60% of Australians voted in a particular way, which was no. What's Qantas's role, or Woolworth's role, in trying to undermine that? And I think that's an overreach from a governance perspective, and I think perhaps is is more a currency thing of being in the headline, maybe not for the right reasons. So I think companies have got to be very careful where corporate governance then bleeds into politics and getting actively involved in reflecting their view in politics. On the other side of the coin, absolute classic last week from Jamie Dimon, the CEO of JP Morgan, who to say is an industry veteran is an understatement and has been through incredible market cycles. Historically has been a supporter of the Democrats, both personally and also as a business, yet last week came out and with some reasonable support for the MAGA and Trump side of the argument. So there's someone that's presenting a very well-rounded case of not just being in a political lane, but trying to look at the world in a more objective way where you can see both sides of the coin. Excellent example of great stewardship from Jamie Dimon. That's why he's been the success that he has for as long as he has.
Indeed.
So companies have got to be very careful overstepping that mark. So it's a very, very interesting space and very controversial because rather like many things in society right now, you're either one thing or the other. And if you're on the other side, you're hated. And if you're on the other side, you're mad. And there's that sort of yin and yang that we seem to be very, very pushed apart in terms of our views. And in reality, we're all trying to do the same thing, have a better environment to live in. Whether ESG actually creates that or whether it's just simply, let's call it what it is, perhaps certainly through my lens, a bit of a marketing ruse to put a tick on something that makes it compliant to invest in without that tick being authorized by anyone that's regulated or with any level of consistency, and enables you as the investor, and I don't know how this sits from an ESG point of view, but enables you to be charged about 40% more for the service, which doesn't actually outperform. Strange mix of events in there, hey?
Indeed. You'd hate to pay more for something that does worse.
If there's absolute value add,
and of course.
And that value add, I'm not just going to be a capitalist and say in regards to outperformance, but if there's a value add in terms of positive impact on the environment,
great,
then that's a tick and no one's going to stand in the way for that. But if it's not really got any direct impact on the environment, which having an oil company rated above an EV business is a strange one, or a company that sells billions of cigarettes seen in a better light because it doesn't sell alcohol, is a very, very strange lens to look through.
So final question for you, AB, before we wrap up. What's your practical tip, or what are your practical tips out there for investors who are trying to navigate this space?
I'm sure there are a few things that we've mentioned in our time together today, Mitch. And I mean, the intention when we sit down and do these podcast interviews is not to create controversy. We're just trying to present a view of the world, and you can form your own on the back of that. I would add that opinion and facts, facts typically outweigh opinion, at least in my mind. Tips I would give to an investor would be, number one, be very careful about what you're paying for. Just because it says it's ESG, is it really? And I think we've given a couple of examples of companies where you can sort of look and go, I'm not really sure how that one's across the line in terms of doing that. And again, without smashing Woolworths too hard, if you look at the way that from a society point of view or social point of view, you look at the way that the price gouging is happening at the moment. You got a farmer that's earning $1.90 a kilo for producing zucchini, and they're being sold to $5.90 in the shop. Okay, you've got to make some money, but that seems to be a bit of a price gouge.
Yeah.
Same with milk, and we went through that a couple of years ago with the dairy farmers getting cents in the dollar, and yet milk being $5.50, $6 for a couple of litres. When you have a view on social, it's got to be a win for everybody, and I think that sort of example of a price gouge, if you can call it that, in a time when your average Australian is really struggling financially, is also something that needs to be called into question, whether that's a governance or a social issue from an ESG perspective. That's something for that company to look at. So tips for investors: number one, be aware that yes, you might feel that your conscience is purged by investing in something that's ESG related, but how ESG is it actually really? And more importantly, those businesses that you're investing in, are they actually making an impact at the, no pun intended, coalface of the problem? And Fortescue is actually a really good example as a surprise, which is a mining company which is in the dark hat camp, but is actually making substantial inroads in making sure that it's better than what it is. And I think as human beings, all of us can aspire to be a better version of ourselves. That's a good goal to have. So number one, is ESG actually making any difference in the investment frame that you're looking at? Number two, be aware that you're signing up on average, and this isn't the case for all funds, but chances are you're going to be paying more in terms of fees for that particular investment mandate. And number three is, are you getting value for money with that additional fee that you're paying, which is, ideally in the investment space, not just a better outcome at the coalface from an environmental point of view, but better performance for you as the investor, because you, of course, are putting up the money. You're the other stakeholder in here. So there are three things. On the other side of the coin is using your own lenses. And I guess, all of us have a lens to look through. As an investor, your goal is to, I guess, optimize your return through the first lens. Through a secondary lens might be through not doing the wrong thing. And so you can apply your own screen based on your own values and conscience. So, for example, we've had in the past clients whose religious beliefs stop them investing in things like banks or certainly gaming, because they're not allowed to invest for interest, to make money on interest. It's not part of their religious belief. So that's something that they can screen out themselves, and it's a tick. If you've got companies that do business with certain geopolitical regimes around the world, you may choose not to invest in those companies based on your own beliefs. If you have certain sectors that you don't have a lot of time for, so pesticide manufacturing, for example, and as someone that owns and runs an organic farm, that's something that's actually quite up on my list. So my lens for the environment is, personally in business, can be very, very different. Our job as a business is to help our clients. So how we conduct ourselves personally is another matter. So for me personally, I have quite an environmental bias on a lot of the things that I do, but I try and be objective as to whether that is a genuine environmental bias or whether it's just a virtue signaling box tick. So there's some lenses for people to look through to keep them on the straight and narrow. And I guess this comes down to being more informed as an investor. And our goal here at Australian Investment Education is very clear, to increase people's financial literacy and awareness of these things, so that when it comes to making decisions, what they think they're doing versus what they are doing and the impact that those decisions have aren't a surprise. It's what you expected.
Very nice. Thank you very much for your time, AB.
My pleasure. Anytime, Mitch. There you have it, guys. Make sure you like, comment, subscribe. Most importantly, hit the notification button, and we'll look forward to hosting you next week.